And so when we finish studying this chapter, we should be able to explain this idea of cost drivers and how they affect cost behavior. We should be able to show how changes in these cost driver levels affect variable and fixed cost. We're going to explain step and mixed cost behavior. We're going to create a cost volume profit graph and understand the assumptions behind it. We're going to calculate break-even sales volume in total dollars and total units, calculate sales volume in total dollars and total units to reach a target profit. We're going to just differentiate between contribution margin and gross margin, and then we're also going to cover slightly the effects of sales mix on profits, which is discussed in Appendix 2A, and compute cost volume profit relationships on an after-tax basis, which is covered in Appendix 2B. So cost drivers are measures of activities that require the use of resources and thereby cause costs. Cost behavior is how the activities of an organization affect its cost. So an organization may have many cost drivers across the various activities of its value chain. Exhibit 2-1 shows how activities link resources and their costs with the output of products or services. For example, an activity that requires resources and thereby causes costs for Boeing is installing seats. This activity uses many resources, but let's consider two: the seats themselves, which Boeing purchases from a subcontractor, and labor for installing the seats. One measure of activity, the number of seats installed, is an appropriate cost driver for the cost of the seats. A different measure of activity, such as labor hours used in installing the seats, is a cost driver for the cost of labor resources. An organization has many cost drivers across the various activities of its value chain. This exhibit lists examples of resource costs and potential cost drivers for activities in each of the value chain functions. How well we identify the most appropriate cost drivers determines how well managers understand cost behavior and how well managers can control costs. So for instance, if we identify something as a cost driver that really isn't a cost driver, or that it's not the most important cost driver, and we spend time and effort trying to influence something related to that, then we're really not maximizing very efficiently until we find out that that's really not the important cost driver. We're not really maximizing our efforts very efficiently and maybe damaging the firm further. So if we look at these value chain, the value chain and example costs, we see things like research and development, which include salaries of personnel and cost of market survey and salaries of product and process engineers. Or we can look at the design of product, services, and processes, which include the salaries of product and process engineers, or the cost of computer-aided design equipment used to develop prototypes of product for testing. Further, we can also look at production, which include costs such as labor wages, supervisory salaries, or maintenance wages, depreciation of plant, property, and equipment, and energy costs. Or we can look at a cost driver like marketing, which includes cost of advertisements and the salaries of marketing personnel. And so when we talk about these different value chain functions, that is the marketing or the research and development or the production, each of those functions, right, has cost drivers. And when we talk about the cost drivers, then we're talking about items such as, for marketing, the number of new product proposals or the complexity of proposed products. With respect to research and development, we could talk about a cost driver such as the number of engineering hours or the number of distinct parts per product or labor hours. So there are multiple different dimensions to this idea of cost driver as it relates to the value chain. And so this just goes on to talk about the same items that we were talking about earlier with respect to the different functional areas in the value chain, either production or marketing, and then some examples of the cost drivers related to those functional value chain places. And then lastly here we have the consideration of distribution and customer service. And again, some examples of cost drivers related to those functional areas. So to understand cost behavior, it is important to distinguish variable cost from fixed cost. So accountants classify cost as variable or fixed depending on how much they change as the level of a particular cost driver changes. A variable cost changes in direct proportion to changes in the cost driver. In contrast, changes in the cost driver do not immediately affect a fixed cost. The term fixed cost describes the behavior of cost with respect to the cost driver, but a fixed cost can change due to factors other than changes in the cost driver. For example, heating costs are commonly fixed and do not change with respect to the production volume cost driver. Nonetheless, heating costs can change with respect to factors not related to the cost driver, such as changes in the price of oil or electricity or unusually warm or unusually cold weather. Pay special attention to the fact that the terms variable or fixed describe the behavior of the total dollar cost, not the per unit cost, which has the opposite behavior. Total variable costs increase as the cost driver increases, but variable costs per unit remain constant. Total fixed costs remain constant as cost driver activity increases, but fixed costs per unit decrease. Cost behavior cannot always be accurately described as simply variable or fixed. Cost behavior depends upon the decision context and the circumstances surrounding the decision for which the cost will be used, as illustrated by examples that are going to follow. Further, cost behavior also depends on management decisions. Although we describe fixed cost as unchanging, regardless of changes in the cost driver, this description holds true only within limits. For example, rent costs for a production building are generally fixed within a limited range of activity, but may rise if activity increases enough to require additional rental space, or may decline if activity decreases so much that it allows the company to rent less space. The relevant range is the limit of cost driver level within which a specific relationship between cost and that cost driver is valid. So let's walk through an example. Suppose that total monthly fixed costs are $100,000 for a General Electric light bulb plant as long as production is between 40,000 and 85,000 cases of light bulbs per month. However, if production falls below 40,000 cases, changes in production processes will slash fixed costs to $60,000 per month. On the other hand, if operations arise above 85,000 cases, rentals of additional facilities will boost fixed costs to $115,000 per month. This figure 2-6 graphs these assumptions about cost behavior. The top figure shows a refined analysis that reflects all of the complexities we just discussed. The bottom figure shows a simplified analysis that focuses only on the cost in the relevant range, ignoring the issue of cost behavior outside the relevant range. Within the relevant range, that is highlighted yellow, the refined and simplified analyses coincide. However, the refined description at the top of Exhibit 2-6 explicitly shows the rental cost at the levels of activity outside the relevant range. The simplified description at the bottom of the exhibit shows only the rental cost for the relevant range and uses a dashed line outside the relevant range to remind the user that the graph cost is outside the limits of the relevant range. So now we want to talk about step and mixed cost behavior patterns. Step costs are costs that change abruptly at different levels of activity because the resources are available only in indivisible chunks at step cost. For decisions where the range of activity is limited to a single step of the cost function, we consider the cost a fixed cost. For decisions where the range of activity encompasses many steps, the cost behaves more like a variable cost. With respect to mixed cost, these costs contain elements of both fixed and variable cost behavior. the fixed cost element is unchanged over the relevant range of activity level, while the variable cost element of the mixed cost varies proportionally with cost driver activities. You might think of fixed cost element as the cost of creating the capacity to operate, and the variable cost element as the additional cost of actually using that capacity. So panel A of Exhibit 2-7 illustrates a decision where a step cost could be treated as a fixed cost. In this example, when oil and gas exploration activity reaches a certain level, the company must lease an additional rig. Each additional rig lease defines a new step in the cost function, which supports a new, higher volume of exploration activity. The step cost behaves as a fixed cost as long as all of the decision alternatives remain within the relevant range of a single step, such as within the highlighted relevant range of the second step in the cost function shown in panel A. Panel B of Exhibit 2-7 illustrates a decision where step cost could be treated as a variable cost, and so panel B is to the right. The cost function shows the wage cost of cashiers of a supermarket where the individual cost steps are uniform. Each cashier can serve an average of 20 shoppers per hour. In a decision about staffing, where the number of shoppers is expected to range from 40 per hour to 440 per hour, the required number of cashiers to match the number of shoppers would range between 2 and 22. Because the range of the number of shoppers in this decision spans a large number of equal-sized steps, this step cost behaves much like a variable cost, and for this decision, we can assume step cost is variable with little loss of accuracy. Many costs cannot accurately be described as simply fixed or variable. Several factors make the behavior of these costs more complex. First, cost behavior sometimes differs across different ranges of activity. It is important to always consider whether the assumptions about cost behavior apply in the relevant range for your decision. So consider situations where managers are trying to evaluate the effect of changes in the volume of goods or services produced. For example, managers might be interested in upward changes, such as increased sales expected from increases in promotion or advertising. On the other hand, managers might be interested in downward changes, such as decreased sales expected due to new competitors entering the market or due to a decline in economic conditions. While such changes in volume may have many effects, managers are always interested in the relationship between volume and revenue or sales, or expenses or costs, and net income or profit. We call this cost volume profit analysis. So let's walk through an example. Amy Winston, the manager of food services for one of Boeing's plants, is trying to decide whether to rent a line of snack vending machines. Although individual snack items have various acquisition costs and selling prices, Amy has decided that an average selling price of $1.50 per unit and an average acquisition cost of $1.20 per unit will suffice for purposes of this analysis. She predicts the revenue and expense relationships. The managers of profit-seeking organizations usually study the effects of output volume on relevant revenue or sales, expenses and costs, and net income or net profit. We call this study cost volume profit analysis. The managers of nonprofit organizations also benefit from the study of cost volume profit analysis. Managers often use break-even graphs because these graphs show potential profits over a wide range of volume more easily than numerical exhibits. Whenever you use graphs or other representations depends largely on your preferences. However, you need to explain a cost volume profit model to an audience. A graphical approach can be most helpful. Note the concept of relevant range applies to the break-even graph. Almost all break-even graphs show revenue and cost lines extending back to the vertical axis as shown in Exhibit 2-7. This approach is misleading because the relationships depicted in such graphs are valid only within a particular relevant range of volume. Nevertheless, for presentation purposes, most managers extend revenue and cost lines beyond the relevant range. So the most basic cost volume profit analysis computes the monthly break-even point in number of units and in dollar sales. The break-even point is the level of sales at which revenue equals expenses and net income is zero. And so if you recall, earlier we talked about that the contribution margin per unit, that is what the selling price minus the variable cost equals the contribution margin. This contribution margin is considered as what is left over that goes toward covering fixed costs. And in this case, the contribution margin per unit is 30 cents. And we see beneath there the calculation of the break-even units, which is the $18,000 in fixed costs that we had previously, divided by the 30 cents per unit that's generated to get us to a 60,000 unit break-even. And so that means that if we sell less than $60,000, we're not covering all of our fixed costs and we're losing money. If we sell exactly 60,000 units, we are at zero profit. If we sell more than 60,000 units, we're going to make money. And then we talk about the contribution margin ratio, which again says, well, if my selling price is 100%, my variable costs are 80% of that. That is $1.20 is 80% of $1.50. Then we have a contribution margin of 20%. When we sell enough units to generate a total contribution margin, which is total number of units sold times the unit contribution margin, equal to the total fixed cost of $18,000, then we're at our break-even point. The equation method is the most general form of analysis, one that you can adapt to any conceivable cost volume profit situation. I'm sure you're familiar with the typical income statement. We can express any income statement in equation form or as a mathematical model. And so here we just simply have the same calculation that we just talked about presented in the equation method, or where n is equal to the number of units to be sold, and with the equation being that sales minus variable expenses minus fixed expenses equal net income. Total sales in the equation is a price times quantity relationship, which we expressed in our example as $1.50 each. To find the dollar sales, multiply 60,000 units by $1.50, which yields the break-even dollar sales of $90,000. You can also solve the equation for break-even sales dollars without computing the break-even point by using the relationship of variable costs and profits as a percentage of sales. And that's what we have in this slide. So to compute the target sales volume in units needed to meet the desired or targeted net income, we adapt the basic break-even formula. The only real difference from the normal break-even analysis is that here we use a positive target net income instead of a break-even net income of zero. So in this case, the given condition is the 60,000 unit break-even point. We will recover all expenses at that volume. Therefore, the change or increment in net income for every unit of sales beyond 60,000 would be equal to the unit contribution margin of $1.50 minus $1.20. That's sales minus cost, or 30 cents per unit. If 1,440 were the targeted net profit, then 1,440 divided by 30 would show that the target volume must exceed the break-even volume by 4,800 units, or would be 60,000 plus 4,800 units, or 64,800 units. Targeted sales volume in dollars then is $97,200, which is our target number of units to meet our target and net profit times the sales price of $1.50 each. In this case, the given condition is the 60,000 unit break-even point. We will recover all expenses at that volume. Therefore, the change or increment in net income for every unit of sales beyond 60,000 would be equal to the unit contribution margin of 30 cents, or $1.50 minus $1.20. If 1,440 were the target net profit, $1,440 divided by 30 cents would show that the target volume must exceed the break-even point by $4,800. It would therefore get us back to the 60,000 plus the 4,800 units, or 64,800 units. Target sales volume, again in dollars, is $97,200. So let's consider how cost-volume-profit relationships apply to nonprofit organizations. Suppose a city has a $100,000 lump sum budget appropriation to conduct a counseling program for drug addicts. The variable costs for counseling are $400 per patient per year. Fixed costs are $60,000 in the relevant range of between 50 and 150 patients. We can use the break-even equation to solve the problem. So let N be the number of patients. Substitute the $100,000 lump sum budget for sales, and note that sales equals variable expenses plus fixed expenses if the city completely spends its budget. Therefore, the city can serve 100 patients. So now suppose the city cuts the total budget appropriation for the following year by 10%. Fixed costs are going to be unaffected, but service will decline. The percentage reduction in service is 100 minus 75 divided by 100, or 25%, which is more than the 10% reduction in the budget. Unless the city restructures its operations, the service volume must fall by 25% to stay within budgets. And so what we're saying is that, well, the city cut its appropriation by 10%, the budget would then be $90,000 or $100,000 minus 10%, or $10,000. Based on a $90,000 budget, which we substitute for sales, assuming that fixed expenses remain the same at $60,000, we have variable expenses that then become $90,000. And based on that, we have an N of $30,000, which is divided by $400 variable costs, and it gets us to 75 patients. So you can see that the difference between $10,000 in budget amounts to a difference between 100 patients at $100,000 or 75 patients at $90,000, and that 25 patient difference is a 25% reduction between years as a result of a 10% reduction in budget. So in addition to weighting the various effects of changes in fixed and variable costs, managers need to consider their firm's ratio of fixed to variable costs, called operating leverage. In highly leveraged companies, that is those with high fixed costs and low variable costs, small changes in sales volume result in large changes in net income, right? Because if we have a small change in sales volume, it lowers our revenue without any commensurate change in fixed costs by definition, which falls to the bottom line. Changes in sales volumes have a smaller effect on companies with less leverage, or that is lower fixed costs and higher variable costs, because as a variable cost by definition will change as the revenue falls as a result of selling fewer units. So the impact of selling fewer units is offset by a reduction in variable costs, which again, that flows to the bottom line, but the impact on it is much less than if we had high leverage or higher fixed costs. In addition to weighing the various effects of changes in fixed and variable costs, managers need to consider the firm's ratio of fixed to variable costs, this idea of operating leverage, right? So again, we talk this idea of a small change in sales volume is equal to a large change in net income. So this exhibit shows cost divided on two different dimensions. As shown in the bottom of the exhibit, the gross margin uses the division on the production or acquisition cost versus selling and administrative cost dimension, and the contribution margin uses the division based on the variable cost versus fixed cost dimension. Too often people confuse the terms contribution margin and gross margin. Gross margin, also called gross profit, is the excess of sales over the cost of goods sold. Cost of goods sold is the cost of the merchandise that the company acquires or produces and then sells. In our illustration, the contribution margin and the gross margin are identical because the cost of goods sold is the only variable cost. So volume is determined not just by total sales, but also by sales mix. And when we talk about sales mix, what we're talking about is the relative proportions or combinations of quantities of goods that comprise total sales. If the proportions of the mix change, the cost, volume, profit relationships also change. So suppose Ramos Company has two products, wallets or W and key cases or K. What is the break-even point for each product? And so we're given the sales at $8 and at $5. We're given the variable expenses at $7 and at $3, which get us to the contribution margins of $1 and $2 for each of the wallets or key cases. And then we're given fixed expenses of $180,000, which result in net income of $270,000. And so again, our question is, well, what is the break-even point for each product? And the typical answer assumes a constant mix of 4 units of W for every unit of K or keychain. Therefore, we let K equal the number of units to produce K to break even, and 4K equal the number of units of W to break even. So the break-even point is 30,000 units of K or keychains plus 120,000 units of wallets, which is equal to 150,000 units. So again, we're talking about the mix here, right? 30,000 units of keychains plus 120,000 units of wallets is going to equal 150,000 total units. And that is the sales mix to get to a break-even point. So suppose Ramos Company sells only key cases and fixed expenses stay at 180,000 units. And the break-even point is then 90,000 key cases. If Ramos sells only wallets and fixed expenses stay at $180,000, we can see that by calculation the break-even point is 180,000 wallets. So when the sales mix changes, the break-even point and the expected net income at various sales levels change also. For example, suppose overall actual total sales were equal to the budget of 375,000 units. However, Ramos sold only 50,000 key cases. We see by calculation here that the change in sales mix has resulted in a $245,000 actual net income rather than the $270,000 budgeted net income. This is an unfavorable difference of $25,000. The budgeted and actual sales in number of units were identical, but the proportion of sales of the product bearing the higher unit contribution margin declined. So as part of our cost volume profit analysis, we discussed the sales necessary to achieve a target income before taxes of $1,440. If Boeing pays income tax at a rate of 40%, what would the new result be? Suppose the target net income after taxes was $864. The only change required to introduce taxes into the general equation illustrated in the chapter for calculation of volume required to achieve a given profit income is to substitute target after tax net income divided by 1 minus the tax rate. On the right-hand side of the equation, target sales minus variable expenses minus fixed expenses equals the target after tax net income divided by 1 minus the tax rate. Thus, letting N be the number of units to be sold at $1.50 each with a variable cost of $1.20 each and total fixed cost of $18,000, sales would be 64,800 units produced, an after-tax profit of $864 as shown here, and a before-tax profit of $1,440. And so suppose that target net income after taxes was $1,440. Here we can see by calculation that the volume would then need to rise to 68,000 units versus the 64,800 units we were talking about earlier if we were talking about an after-tax profit, a pre-tax profit of $1,440 based on a 40% tax rate. So that concludes Chapter 2. Again, please go back and reread the chapter and make sure that you're comfortable with it, and then proceed to the discussion forums and the learning exercises. Thank you.